Good morning, everyone, and thank you for showing interest in this webinar on impact investing and alternative credit. As you know, impact investors like to fix problems, and boy, do we have problems. For a long time, even before COVID struck, we were motivated to fund the almost $2.5 trillion funding gap to reach the Sustainable Development Goals by 2030. And much of that funding was targeted towards Africa. However, the problem statement has since ballooned, and we can see from some of these stats here, for instance, our government's revenue shortfall is now approaching 300 billion for this year. More than ever, what this does is to highlight that investments in social and environmental infrastructure, be it access to healthcare, clean water and energy, education and affordable housing, will simply not be met by governments and development banks alone. And therein lies the opportunity for purpose-driven impact investing to respond to growing demand and the innovative supply of solutions that we collectively create. It also heightens the urgency of government and private sector to work together to forge a more inclusive growth path. So Corneleo and I are going to address how we are trying to respond proactively to the current crisis. Globally, there's been a coming together of impact investors called the R3 Coalition, which is led by the GIN, the Global Impact Investing Network, and others such as Andy, the Aspen Network for Development Entrepreneurs, both of whom we are members of. And they are driving a strategy collectively that says we should get behind 3 phases in response to COVID: the response, the recovery, and then the resilience building phases. The response phase has largely been about dealing with an immediate need to respond to an emergency, and we continue to negotiate around liquidity constraints with our underlying investments and provide relief where possible. And as we slowly enter a recovery phase, I think we saw just recently that there's been an uptick in business confidence, which is slightly encouraging at this stage. But we are focused on maintaining and restoring lost capacity and renewing or granting new funding. Corneleo will give further color to this before I wrap up with some thoughts on how we can build more resilience in our world. Next slide, please. So sadly, unemployment, already so high in our country, has increased through lockdown. And currently, it's estimated about 7 million people in South Africa are unemployed, with our National Treasury predicting that a further 2 million might become unemployed through this crisis. Some of you may be familiar with our 2 job creation funds developed in partnership with our National Treasury's Jobs Fund program. And the summary statistics for these funds you can see in front of you. What they really are blended finance solutions underpinned in both cases by a guarantee from the Jobs Fund in order to crowd in private sector funding, largely pension fund and a smattering of insurance funding that these funds have attracted. And they really target sound credit opportunities whose business models typically respond to demand for goods and services that are relatively ignored by larger financial service providers, but there are growth sectors in our economy and therefore net job creators. To date, the combined funds have performed consistently above benchmark for a 5+ year track record in the original fund, and they've grown to almost 1.6 billion rand. Now, out of this, we've been working hard to keep the loans that are in there safe, but also to make new loans. And so we've continued to issue loans of almost 200 million this year, most of which has actually been in recent months. And in addition to that, the funds have also created, well ahead of their target job creation, of over 15,000 jobs that we've created since inception. And again, of interest is that of this, we've actually added about 5,000 of those jobs, a little bit more than 5,000 of permanent full-time jobs this year alone. Although, sadly, we can't say that those jobs were actually created in this year because they have to be independently verified and counted after a 12-month lag. And so unfortunately, you can't yet tell what the effect of new loans that we've made this year have been in terms of job creation. Frankly, at this stage, we are targeting job preservation. Nevertheless, I think the message is that we believe more funds like this are needed to provide liquidity to the market and also to tackle unemployment at scale, which we desperately need. Next slide. So one initiative where we've been pretty proactive, and I'm very pleased to share with you, is an intervention in response to COVID-19, working again through the Jobs Fund. Back in about April, the Jobs Fund initiated a grant program to provide temporary relief to its current partners like ourselves in the Jobs Fund program. We didn't require funding ourselves, obviously, but we did identify one of our underlying investees in the fund, the Small Enterprise Foundation, or SEF, as being strongly positioned to disperse grant funding to its client base. Now, SEF has been operational since 1993, and since then they've dispersed about over 8 billion rand in small loans to their client base of largely rural micro enterprises run by women. So it's very much a social purpose business based on the Grameen model out of Bangladesh, where SEF adopts a group lending methodology, kind of stokvel and peer pressure built into the repayment ethos. And they've maintained, as a result, a very strong track record with exceptionally low default rates over the years. However, with lockdown damaging small business prospects, they simply weren't operational in the early months. We motivated to Jobs Fund for a once-off grant payment of about 1,700 to each of 20,000 of SEF's most vulnerable clients. So 20,000 is about a fifth of their client base, and they've particularly been able to target the most vulnerable of those. And I'm extremely proud to tell you that our team has secured over 34 million rand as a once-off grant to be paid at the end of August. And I'd also like to applaud the Jobs Fund for responding so swiftly and proactively. They really have been an exceptionally strong partner with us, and evidence, I think, of the kind of capable state that we need to see more of. I'll hand you over to Corneleo now to take you through some of the specifics around particularly the response and recovery across our credit portfolios. Next slide.
Hi, everyone. So as Heather said, we are speaking about just some of the responses that we've seen, and I think the way to look at it is firstly to see the impact that COVID-19 has had on businesses. I think firstly what we've seen is obviously profitability being impacted severely. We've seen reduced liquidity in a number of these businesses. We've seen reduced asset valuations because of the uncertain outlook for future earnings and the ability to monetize assets in the future. And we also have seen an increased cost burden in terms of ensuring that there's safe operational and working environments for employees as the economy opens up again. I think what that all has resulted in is obviously an increased level of gearing on corporate balance sheets, and also a limited or reduced capacity to service debt obligations. So that's been the impact. And then looking at how corporates have responded, their first their first focus has been on preserving liquidity to ensure that the business can continue to trade through the lockdown in a reduced trading environment. We've seen businesses trying to convert costs that are fixed in nature into more variable type costs and manage that cost base. And unfortunately, as Heather mentioned, there's been there has been a focus in terms of managing staff costs, and that has led and will lead to more job losses in the economy. We've also seen businesses manage their working capital cycles, reduce capital expenditure, and also cut dividends where dividends were being paid. Now, I think that is a general sort of assessment of how businesses have been impacted. What we have, however, seen is that different size of businesses have been impacted in different ways, and obviously larger businesses have had more levers that they can pull. So larger corporates have more financial flexibility. They have more funders that they can approach in times of distress to see if they can get more liquidity in. They also typically have the ability to refinance their debt as and when they come up for maturity. where the mid-size and smaller corporates typically have a smaller funding base, they have less financial flexibility in terms of levers they can pull, and they also have lower levels of working capital or liquidity facilities to actually manage through a cycle of strained liquidity. When you look at how the different corporates have managed the process, obviously the large corporates have generally been able to service their interest. They have received support from their liquidity providers in terms of keeping those facilities available. And they've also refinanced debt maturities, let's say, that were coming up in the next 12 months, just to ensure that they are managing large liquidity events. What we have, however, seen is that they did require, in some cases, some financial covenants to be renegotiated, just to give them that headroom to avoid any events of default on loan agreements. The mid-sized corporates, there again, did have some liquidity facilities that were maintained. Again, covenant waivers were required, but I think there we saw a larger strain on liquidity, and in many cases there, we also had to, be comfortable to defer interest payments as well as capital repayments. Moving to the next slide, we wanted to look at we focus a lot on the responses from the corporate side. I want to also have a little bit of a discussion around how debt funders and shareholders have responded, and then look at how we progress into the recovery phase as the economy starts to open up again. So as I mentioned, on the corporate side, there's been a focus on conserving liquidity, ensuring safe working environment for returning customers, implementing a sustainable cost base, and obviously a focus on customer retention. In response for these proactive measures, debt funders were asked and generally obliged in terms of keeping working capital funding available to the corporates. Covenants were generally renegotiated or waived where breaches were a concern, and then also interest capital deferments were provided, just during over a shorter term to assist with that liquidity position. The response from shareholders to date has been, to engage with funders, making it clear that they are long-term supporters of the businesses that they own, ensuring that management remain incentivized and that they are retained and that their interests are aligned with both the equity and debt funders, and then continuing to make sure that environmental, social, and governance principles are adhered to. Moving on to recovery phase, what we are seeing is that corporates are very focused on retaining and growing market share, emerging from this crisis. They are focusing on making sure that profits that are made is converted into cash, making sure that the cost structure that they have implemented during the lockdowns, that discipline with regards to cost is maintained, and that repurposed cost base is actually scaled up, ensuring improved profitability. On the recovery side from debt funders, there will be liquidity or funding required, because what you would have seen is working capital balances have been run down, stock may have been run down, debtors have been collected, and what you will find is that corporates now require a portion of working capital funding to actually stock up and go through a working capital cycle in terms of making sure that they have the inventory available to trade again. And I think what we will see now is a renegotiation of debt packages. Once there's a clearer understanding of the funding profile of these businesses, to make sure that the capital structures are sustainable. And what we may see is that there is some element of debt that is proportionately subordinated to the senior portion with a view to the business being recapitalized over time. And that's obviously where shareholders then come in the recovery phase, is once there is more certainty around earnings and the sustainability of businesses to actually recapitalize these businesses and making sure that the capital structure integrity is retained. I think in terms of the investor side, what can be played is to look at flexibility in existing mandates, where there is an element of conversion of debt or restructuring of debt that's required, that there is an allowance provided to the managers to be able to implement those restructures because ultimately that is an exercise to ensure that capital is protected over time. And then secondly, I think there is an opportunity for new funds to be launched, which is targeted at providing new senior and mezzanine funding or subordinated funding to counterparties that are experiencing strained capital structures, to provide them with a new long-term sustainable capital structure, and providing shareholders with that bridge to get the certainty they require to inject new equity into the business. So that really is an overview of the response and recovery phases, and handing over to Heather now to take you through the rest of the presentation.
Thanks, Corneleo. So picking up on your last point then, I think, and moving on to the third R, the resilience, how do we deepen, how do we bring new product to market, how do we structure our industry differently so that we build in a greater degree of resilience in how we operate? And I think this really is an opportunity. It certainly highlights both the problems and the opportunities, I suppose. But I think that there are some areas, as Corneleo mentioned, deepening into perhaps the more mezzanine and kind of, moving up the risk curve and opportunities there that these kinds of circumstances present. But also, I think another area where we face significant backlogs and severe underspending recently by government and SOEs is in infrastructure, as the chart here shows. And as the long-term savings industry that we represent or are part of, we've not invested sufficiently in infrastructure. And, obviously we know that there are complex and sometimes political reasons for this. However, there are some big movements underway to try to rectify this. And I think two recent developments could produce much needed tailwinds to support, building out more infrastructure-related funds. The first is the newly created infrastructure focus created in the Office of the Presidency. So we are quite closely plugged into that through our industry member body, ACISA, who've been playing a large role along with B for South Africa to coordinate efforts between the private sector and the Office of the Presidency. And collectively, they've announced and workshopped their intention to partner with private sector to attract 2.1 trillion rands needed over the next several years to help fund much needed infrastructure in 6 critical and priority areas that have been identified by this office. And you see them here. These are in the digital infrastructure, energy, transport, water and sanitation, agriculture, and human settlements areas of the economy. So that's one tailwind. A second possible tailwind is a much more recent development, and could come from the recently announced proposal to build on the sustainability elements outlined in Regulation 28 for pension funds, as well as the guidance notice. And what government have put out a proposal for, and still, it's open to comments, is to make provision for an explicit category for infrastructure investments within Reg 28. So it's not quite prescription, but it's a bit, I would liken it to the allocation to Africa, where, once that was made explicit, it did make consultants and investors take note and develop product around that, despite the fact that they could have taken money, into Africa in any event. So I think time will tell whether we can succeed at building blended finance solutions in these much needed areas. We really do need this to propel our country on a more sustainable and inclusive growth path, we believe. Next slide. So finally, I'm really very pleased to share with you a timely report that will be published soon. Ashburton commissioned Intellidex last year to conduct research into the prevailing attitudes and constraints amongst pension funds towards impact investing. I only have time to share a few highlights, but it will be publicly available as a resource to promote the importance of impact investing more broadly, as well as there will be a webinar, which I'll tell you about in a couple of slides' time. The survey broadly covered about 65% of the pension fund industry in South Africa, or roughly 2.6 trillion rands worth of investments. Next slide. So first, let's deal with some of the constraints that the survey picked up on. Interestingly, by far the largest perceived constraint related to a lack of transparency and difficulty in measuring impact, which does support the ongoing work in a number of industry bodies like ACISA, like National Treasuries, IFC-led working groups who are trying to develop and inculcate better measurement taxonomies. And I think, you know, it's great that those are already up and running, and we hope that they will be made publicly available as soon as possible to enable or at least, you know, tackle this constraint. Then also financial performance concerns were raised as a concern, and as well as the availability of suitable product was also flagged. Next slide, please. Moving to the most important ESG issues amongst pension fund investors. Interestingly, BEE was rated as the most common sustainability strategy to be incorporated in a fund's investment policy statement. But this was followed by, and differs from international results that Intellidex looked at, it was followed by a strong focus on actual direct impact strategies as second most important consideration, and then also thematic strategies, such as those linked to megatrends and infrastructure. Another feature was that positive ESG screening was also popular, although negative screening was relatively absent, which is not the case with global trends, where negative screening is quite a big trend. So another interesting differentiation for us. Then within pensions, they considered the social aspect of ESG to be the most important, followed by governance and then environmental concerns. And it was interesting to see which topics were considered most important. For social, it was solving unemployment, with economic inequality coming in second. So I think not really a surprise when you consider where our most pressing social concerns and challenges are. For governance, again, I don't think it will be a surprise that the greatest concern picked out was around business ethics or corruption. So still a very strong concern. And then for environmental considerations, the strongest focus was for solutions addressing our water challenges. Next slide. So I'm delighted to invite you to the official launch of this report on Investing for Impact. It will be on next week, the 19th of August, at a special CFA webinar, details of which you can see, where I'll be in conversation with the lead author from Intellidex, Stuart Theobald, and we really hope that you're able to join us there. Thank you.